China's economy potential hinges on its productivity. Hello everyone, welcome back to The Wealthy Brains. Whenever we talk about China, the first word that comes into our mind is growth. Even after being the world's most populous country, this country doesn't lack growth. In this video, we'll be talking about how China's economic potential hinges on its productivity. While pre-1978 China had seen annual growth of 6% a year, post-1978 China saw average real growth of quite 9% a year with fewer and fewer painful ups and downs. In several peak years, the economy grew quite 13%. I know it's shocking, and to know why China is growing so fast, you need to stick till the video ends. The ultimate question: why is China growing so fast? The answer would be productivity. This word, if you follow, read, or listen to Billionaires Talk or any book, this word is literally everywhere. Similarly, in the case of China, it again reflects its importance. Why the productivity boom? Exactly how did China's economic reforms work to boost productivity, especially in an economy still burdened by the extensive government controls? Prior to the 1978 reforms, nearly 4 in 5 Chinese worked in agriculture. By 1994, just 1 in 2 did. Reforms expanded property rights within the countryside and touched off a race to make small non-agricultural businesses in rural areas. Decollectivization and better prices for agricultural products also led to more productive farms and more efficient use of labor. Together, these forces induced many workers to maneuver out of agriculture. The resulting rapid climb of village enterprises has drawn tens of many people from traditional agriculture into higher value-added manufacturing. Furthermore, the post-1978 reforms granted greater autonomy to enterprise managers. They became more liberal to set their own production goals, sell some products within the private market at competitive prices, grant bonuses to good workers and fire bad ones, and retain some portion of the firm's earnings for future investment. The reforms also gave greater room for private ownership of production, and these privately held businesses created jobs, developed much-wanted consumer products, earned important hard currency through foreign trade, paid state taxes, and gave the economy a flexibility and resiliency that it didn't have before. By welcoming foreign investment, China's open door has added power to the economic transformation. Cumulative foreign direct investment, negligible before 1978, reached nearly $100 billion in 1994. Annual inflows increased from but 1% of total fixed investment in 1979 to 18% in 1994. This foreign money has built factories, created jobs, linked China to international markets, and led to big transfers of technology. These trends are especially apparent within the quiet 12 open coastal areas where foreign investors enjoy tax advantages. In addition, economic liberalization has boosted exports, which rose 19% a year during 1981 to 94. Strong export growth, in turn, appears to possess fueled productivity growth in domestic industries. In one final area, price reform, the Chinese have proceeded cautiously, granting a fair amount of autonomy to producers of consumer goods and agricultural products, but much less to other sectors. Several bouts of inflation have buffered the Chinese economy within the past 20 years, deterring the government from implementing full-scale price liberalization, and high rates of growth also raise inflationary worries. Inflation may pose the only greatest threat to Chinese growth, though so far it's been largely contained. Although economists have some ways of explaining or modeling economic growth, a standard approach is that the neoclassical framework, which describes how productive factors like capital and labor have the neoclassical framework, which describes how productive factors like capital and labor bind to get output, and which offers analytical simplicity and a well-developed methodology. Capital investment plays a big role too. Much previous research on economic development has suggested a big role for capital investment in the economic process, and a large portion of China's recent growth is actually due to capital investment that has made the country more productive. In other words, new machinery, better technology, and more investment in infrastructure have helped to boost output. Yet, although the capital stock grew by nearly 7% a year over 1979 to 94, the capital output ratio has hardly budged. In other words, despite an enormous expenditure of capital, production of products and services per unit of capital remained about an equivalent. This pronounced lack of capital deepening suggests a constrained role for capital. The labor input, an abundant resource in China, also saw its relative weight within the economy decline. Thus, while capital formation alone accounted for over 65% of pre-1978 growth, with labor adding another 17%, together they accounted for less than 58% of the post-1978 boom, a slide of just about 25 percentage points. Productivity increases made up the remainder. It seems that it's higher productivity that has performed this newest economic miracle in Asia. Chinese productivity increased at an annual rate of 3.9% during the 1979 to 94, compared with 1.1% during the 1953 to 78. By the first 1990s, productivity's share of output growth exceeded 50%, while the share contributed by capital formation fell below 33%. At last, the growth and productivity are dependent on each other, and the way China understands and implies it, it's clearly making China the ruling country of the world. With this, we have come to the end of this video. What do you think? Can productivity really affect economic potential? I hope you all enjoyed watching this video, and hopefully this was informative to you. Thank you so much for sticking till the end, and if you enjoyed watching this video, don't forget to like, share, and subscribe to Wealthy Brains. We will see you soon with another amazing video.